A complete guide on trading psychology based on live market experiences. Preface. The Indian derivatives market is one of the largest in the world. With deeper internet penetration and declining transaction cost, this segment of the capital market is deemed to grow significantly. The main characteristic of derivatives that makes it unique is its dynamic nature. This dynamic nature is well reflected in the prices of options contracts that can jump up to 200% or even more, and that too within a few minutes, or even seconds these days thanks to algo-based trading. So it's like playing with fire. If you don't trade with a sound mindset, you are bound to burn your fingers. Therefore, while dealing with derivatives, one needs to exercise special care and caution. The basic framework of trading derivatives is similar to that of the conventional trading of stocks. As it has been pointed out by many market stalwarts, to be successful in capital markets, one does not require a stratospheric IQ, unusual business insights, or inside information. What is needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. The game is all about mindset. This book aims to help you develop this mindset where you have a sound intellectual framework and an unwavering emotional discipline. About Sivakumar Jayachandran. Sivakumar Jayachandran is an ace scalper and one of rare traders who has generated consistent returns by buying options. An entrepreneur by nature, Sivakumar co-founded a startup in healthcare industry and led it successfully to grow into a profitable company with 800 employees. Following his entrepreneurial spirit and testing the waters of trading during the initial stages of his professional career, he entered markets on a full-time basis. Using a sound intellectual framework with unwavering emotional discipline, he has been able to make consistent returns through options buying, a feat achieved by only a few traders in India. His achievements were recognized and an article was published about him on the esteemed Money Control website. He also features regularly on popular online market training platform eLearn Markets. In order to help the traders decode the market, he has also developed an artificial intelligence-based software, Pulse, that has been an instant hit among options buyers since its launch. He started with a vision to empower retail investors who are often at the receiving end of markets dominated by big players. Making his vision come true, he has actively turned to mentoring other traders. He shares his entire knowledge about scalping technique and makes live trades to demonstrate the efficacy of scalping, something which is typically unheard of. Many people have benefited from his efforts aimed at empowering retail traders and are now successful full-time traders and financially independent. This book is primarily based upon his knowledge that he will be sharing during his mentoring programs. What to expect in this book? A trader's mindset is the most important aspect in trading that decides whether a trader will be a successful market participant for long enough or not. This book will dwell into the mind of a trader to reveal all the important aspects that make a successful trader. This book aims to bring to you the mindset of a trader based on live market experiences. Much like other sports and businesses, trading is a high-performance activity. The best results are derived when traders are at their best possible state of mind psychologically and emotionally. This book also aims to make novice traders to be independent thinkers and capable of taking prudent trading decisions. My goal is to make new traders understand what the perils of a poor trading mindset are and how to overcome it. These concepts are derived purely from live market experiences. We will look at the perils of a poor mindset and then look at solutions that are proven and can change the gambler's mindset in you. Chapter 1: Why do 90% of traders fail big in trading? Trading is a tough business and most people who start in the business lose money. And these numbers aren't small at all. They might even be scary to look at. Just like profitable and successful traders have common traits, traders who lose significantly commit the same mistakes over and over again. We will see what these behaviors are and how to avoid them. How does the seed of high expectation grow? High expectations, as you would know, looks upward on rapid momentum to replicate winning influences. Making money in the stock markets does not work that way. It is a very tough business that requires immense knowledge and understanding of market dynamics as well as training one's own mindset. Traders simply focus on indicators, strategies, or formula that can make them rich quickly. They fail to understand that to be successful in trading as a business, you have to go through all the stages a normal conservative trader, investor has to go through. What a trader needs to understand is that success is only possible when you are well versed with knowledge, tools, and a trader's mindset to work together. What are the implications of the seed that has been propagated? Novice traders tend to be overwhelmed by the success formula of one influencer or trader as the Holy Grail. Incidentally, the Holy Grail keeps changing as the success formula of one does not work for another. They go on to look for another Holy Grail by another successful trader and keep on changing strategies. One thing leads to another and unrealistic goals lead you to try every strategy available in the open internet. Change of strategies too often results in you failing to trade with a plan and lack of discipline that is required. Lack of discipline results in you indulging in poor risk management and allow your emotions to take over and dictate terms. That paves the way for the start of the end of your trading business. How can traders avoid succumbing to the same traps? Let's see some simple and effective ways profitable traders have done already. Educate yourself. Work on your mind. Accept reality. Practice. Take it slow. Have humble and conservative expectations in the beginning. Keep learning and improvising. Adapt to changing market dynamics. Scale up slowly. You have to work on yourself to understand your capabilities, risk-taking ability and preparedness to take trades as the first step towards success. Many traders can't accept losses or being wrong. They can just not give up on that SL that has been already put up in the trading terminal and have to keep averaging downwards in the wrong side of the trend. Work on a successful trader mindset that knows what reality is, what the potential is and how far one can go. When you learn from others' experiences, not only your learning curve is shortened, your purse also remains in good shape. The Holy Grail is not something that you look for outside of you. It's within you. What is the roadmap to success? When you include these qualities and basics that a trader needs to repeat day in and day out, you move closer to being a trader who not only loses small but wins big as well. Educate yourself. Find your niche. Learn from experiences of others. Create a rule to trade and stick to it. Follow risk and money management strictly. Don't allow emotions to dictate terms. Remain humble. Your success in trading does not depend on others but how you worked on yourself to create that sound trader mindset. I'm sure you will be able to move into the 10% category of successful traders by following some simple yet doable mentioned above. Chapter 2. The truth behind our struggle to accept change. The very mention of the word change can make many feel uncomfortable. We will be looking at all the reasons why people find it difficult to change as we proceed. We will also see some of the ways not talked about commonly towards the end of the article. Change. What is change in simple language? Change, if you want to understand in simple language, is nothing more than mere need. It is simply the act of replacing something from its current state to a new form. The same applies to human beings as well. Change is the result of a need as required by laws of nature or can be circumstantial as well. Why is it difficult to accept change? When you talk about change, the first thing that comes to mind is resistance. We will see why people resist change and how we can overcome it. Comfort zone. People resist change because it requires them to step out of their comfort zone. It is simply spontaneous human nature to resist change because nobody likes to get out of their comfort zone. People don't even accept change if it is required for good, as it steals them of their comfort. Comfort that will be resultant even after the change is embraced. Related to your trading, I will keep looking for bearish trades when trending OI shows bearish sentiment in trending OI page. Change required. Why would you not change your view when net PCR changes like this? 0.75 to 0.70 to 0.50 to 0.30 to 0.35 to 0.45 greater than 0.60 to 0.70 to 0.80 to 0.90. Fear. People resist change because of the perceived risk or fear associated with change. Behavioral change is rarely a one-act event, as it requires that you transform from the behavior you have become comfortable in. Behavioral change is something that happens gradually and is achieved over a period of time. Well, this may vary depending on what the change is required in. Related to your trading, when you take a trade close to VWAP, you fear the price may bounce back to hit your stop loss. Change required. Taking a trade closer to VWAP is among the best opportunities to keep the stop loss small. Take the trade. If it has to hit the stop loss, so be it. You will let go of the 7 out of 10 times you might have taken the trade with a small stop loss because of fear. Presumption. We tend to presume things or outcomes when a change is called for. The resultant spontaneous question, what if, arises, which become reasons for resisting change. Related to your trading, let's say price has crossed resistance levels with volume. You don't go with the flow presuming that price cannot break levels without taking resistance even once. Change that is required. When price is in strong momentum, it is not a hard and fast rule that it has to take a resistance and then move. Instances like these, you have to go with the flow and change your perception to trade. Infectious ego. Change is the act of replacing something that you are accustomed with. When there is something that points back at you, it is natural to accept it for the change required. You tend to go on the defensive, which in turn results in embracing the change that is required. Related to your trading, today the global markets are bullish. There is talk all around of some good news that is to come and you blindly go long. Price retraces and falls further and you keep averaging. Change that is required. Yes, we could have started the day being bullish, but when market sentiment has changed, we have to. A prudent trade does not hesitate to change his view from being bullish to bearish when need be. You simply embrace and use the technique stop and reverse, trade. Self-competence. Change is normally resisted when you start questioning your own ability to embrace the change. There is skepticism that creeps in that question your own ability to perform in the new thing behavior. Related to your trading, you are always comfortable trading in Bank Nifty and trade only with one stop loss and target. Change that is required. On a trending day where the market does not seem to stop at important support levels and keeps falling, will you not trail your stop losses further to ride the trend? After all, we are all here to run the winners big. Agreed? Ripple effect. When change requires several aspects of you, your activities or behavior to embrace the change, you tend to resist. A change may require that we alter timing some activity or thought process, which may result in you pushing back change for a later time. Related to your trading, you always trade Bank Nifty based on how Dow Jones traded the previous night and how the futures are following up today. There has been a poor day at Dow Jones, but Bank Nifty seems to be rather bullish because crude has fallen 10% just before market open. You keep looking for bearish opportunities. Change that is required. Banking stocks are going to benefit from the fall in crude oil prices, and days like these you would rather look for a bullish setup instead of have the Dow Jones effect still set in. Do not be rigid and be flexible to change when the need of the hours requires it. How to convince your mind to embrace change? Because of the recency effect, I am going to bring your attention to the most recent global event that called for a change. Yes, you got it right. COVID-19. Not to demean anybody, but the need of the hour was to stay indoors at the outburst of the pandemic. We did embrace the change and took to wearing masks and getting used to the new immunity-enhancing lifestyle. We worked indoors and probably forgot how warm the sunlight was. That was the need of the hour, and we embraced the change. We embraced the change because we realized the benefits of embracing the change. Similarly, we will be ever so welcoming change if only we can realize the benefits of embracing change. Secrets nobody reveals about change. People don't realize that change is needed only when required. Change is required when we have not achieved desired results. Change is only required when things don't happen the way they ought to be. Change is not inherently bad like it is perceived to be. Change is good because it bridges the gap of the need that is required to be fulfilled. Accept change as a necessity, as you would know by now that change is a resultant of need rather than a luxury. Realize this, you need to change when there is a need to. So when things are fine and all is good, there is no need for change. Yes, I know you would simply read the above and accept it as a sermon. No, change is required even when you are doing well. As humans, we always aim for the better. A change in behavior or activity is required to end up in better results. This change is obviously for the better, so a change from the normal is still required. Routine becomes habit. It is a known fact that when you repeatedly do things or an act for 21 days, it becomes a habit. A habit is result of something that becomes part of a routine that is followed at its prescribed interval. Change is an inevitable part of our lives. The only constant in humanity is change, and change is an inevitable part of our lives. As we grow, we change in some form or the other and embrace new behaviors that suit the age we are or the relationship we are in. Benefits of change. Call out benefits of change to make the replacement rather more comfortable. When we realize the benefits of change, it will entice us to embrace the change. Bright side of change. Change is unnecessarily associated with negativity and skepticism. Look at the other side and you will find the grass greener on the other side as well. Ability to adapt. Human beings possess an inherent ability to adapt to change. We tend to overlook or underestimate our abilities when we will want to resist the change. We are built by nature to adapt to change, so we don't need to fear change. Challenge yourself. Challenge yourself if you find yourself resisting change. Place a reward to bribe you to overcome this resistance to change. Who does not like rewards, and I'm sure you would like to be rewarded as well. Take action and track the results. Track behaviors and outcome of changed behavior from what it was before the change. You will see obvious results from this change and will be ever ready to be the change. Seek help. There is no harm in seeking help when the need be. Talking to someone who has embraced change and is successful in life helps. I'm sure there is no dearth of people around us who have embraced change. It is important to remember that change is always good. It can help us become better people, and it can help us become better versions of ourselves. I'm sure there are some simple ways provided above that will help you embrace change. Chapter 3. Why many novice traders are forced to exit trading? Trading, like any other business, can be a profitable one. However, several novice traders end their journey with an early exit or see a forced exit. We are going to see all the reasons why this happens and how to avoid them as we proceed below. You have to remain in the game to play the game. Why is the novice trader forced to exit early in trading? There are several reasons why novice traders are forced to exit trading. It could be one reason or a combination of reasons as discussed below. Many traders get an early exit, which is in one way good for their financial and physical health. However, some traders keep repeating the same mistakes over and over again by re-adding funds to their trading account only to be hurt even harder and sooner than before. We will see all these reasons and bifurcate them in basic factors, financial factors and psychological factors. This will make it easy for a trader who has already seen an exit or is on the verge of it to work on these factors. It is very important for a trader to identify where the problem lies. It does not stop at identification but working on remedies to rectify them. Basic factors. Ignorance is indeed bliss, but it is also dangerous and embarrassing. By Ted Nugent. Being ignorant, novice traders simply don't know what's happening around and why it happens in the markets. They rely on tipsters and place their bets. Many traders don't understand that price is impacted not only by local factors but also by global factors. Taking trades simply based on local bias can also prove to be harmful and result in huge losses. Such traders end up making late entries and early exits. A trend continuation forces them subconsciously to make several re-entries that can prove to be costly affairs when pullbacks happen. Traders need to first understand what dynamics of the market are and study all the factors that can impact the markets you trade in. Beware of false knowledge, it is more dangerous than ignorance. By George Bernard Shaw. Half-cooked knowledge. Many traders are killed, not literally, by half-cooked knowledge. They have read some books on technical analysis and seen some videos on some online platforms and jump into trades. Traders tend to rely on tipsters in early stages of their trading career once they have seen some videos on trading online or read a book or two. They feel they have already equipped themselves of the knowledge to trade and avail paid services or subscriptions to take trades based on recommendations. Traders fail to understand that recommendations provided by tipsters are general in nature and you cannot judge if the tip provided will fit the bill for you. They fail to understand that the tipster cannot gauge your risk appetite and decision-making capabilities. You simply cannot gauge with what mindset the tipster provided the recommendation. You are left high and dry when there are technical issues that prevent the next or following messages to reach you. You are left confused and half-cooked knowledge. Many traders are killed, not literally, by half-cooked knowledge. They have read some books on technical analysis and seen some videos on some online platforms and jump into trades. Traders tend to rely on tipsters in early stages of their trading career once they have seen some videos on trading online or read a book or two. They feel they have already equipped themselves of the knowledge to trade and avail paid services or subscriptions to take trades based on recommendations. Traders fail to understand that recommendations provided by tipsters are general in nature and you cannot judge if the tip provided will fit the bill for you. They fail to understand that the tipster cannot gauge your risk appetite and decision-making capabilities. You simply cannot gauge with what mindset the tipster provided the recommendation. You are left high and dry when there are technical issues that prevent the next or following messages to reach you. You are left confused and don't know what to do with open positions and with the little knowledge you have gained. You end up losing. It has been observed that several traders who even take tips cannot succeed because they even tend to enter early in trades. They are often caught off guard because they buy too early and are caught in high volatility. Let's see an example of the above. For instance, a trader is taking services of a tipster and receives a trade suggestion to buy Bank Nifty CE 39,100 above 350 and the CMP of the strike is at 275. They would enter at 300 itself in a bid to capture those 50 points more. The smart mind or the trader does not realize that the price could be volatile below 350, which is why it was recommended to buy above 350. Volatility forced price to hit 225, which is the VWAP price for instance, and exit the trade. The strike price goes not to bounce from VWAP all the way above 350, which was day's high of the strike price. Several such trades can create a dent in your trading account, forcing an early exit from trading in the same fashion or similar fashion. It's okay to make mistakes as long as you learn from them. Never rectify mistakes. Novice traders who exit early in trading share this trait in common. Traders who survive and succeed in the markets are the ones who identify mistakes, rectify it and never repeat mistakes. Traders are unable to rectify or avoid them because of several reasons. Let's put them all down here and I'm sure you will be able to relate to it. They are not even aware that there is a mistake. They are hesitant to discuss mistakes. They don't want to improvise and adapt. They keep changing strategies to override earlier flaws. They create a wrong notion that market is against them. To improve is to change, to be perfect is to change often. By Winston Churchill. Unable to keep pace, markets are ever so dynamic and novice traders are simply not able to keep pace with the markets. Novice traders tend to apply same logic and set up to trade in every market condition. This will never bring in the same returns when market might have been favorable earlier. What logics work earlier may not work forever. It is a change that you need to embrace if you need to be consistently profitable. Strategies that work in trending markets will not work when in consolidation or when trading in ranges. Strategies may not work in range-bound markets that earlier worked in bull markets. The same goes with bear markets as well. Traders who are forced to exit the markets are the ones who cannot simply be open to change. They have not trained their mind to make those quick decisions that help the trader to adapt to market conditions. Let's take an example from how Bank Nifty should have been traded on the 26th of August, 22. Days range on the 25th of August, 22-38850-39450. Bank Nifty traded in a range and was trending downwards towards the end of day to close at 38,850. Day the 26th of August, 22 market opened gap up around 39,100 and faced resistance at around 39,300. If you are a trader who doesn't place a trailing stop loss and took a trade around resistance of 39,300 and waited for the same type of trending day as previous day, you are bound to lose out because there was support before previous day low and moved back to 39,150 levels. Novice traders tend to exit out in panic as they didn't want to accept that they went wrong. You need to book profits when price touched support levels, which is the right thing to do at 39,000 levels. You cannot apply same strategies that worked on one day to work on another day as well. Every day is a new day and your trade setup should drive your trading decisions. Financial factors. Consistency is what transforms average into excellence. Lacks consistency, traders who are forced out of markets are the ones who believe in overnight success. These traders give too much focus on short-term gains rather than long-term goals. Success in trading comes by only when you are making consistent profits over a period of time. You should always approach trading as a business that has long-term goals. Novice traders tend to misunderstand this and focus on short-term wins or losses. There may be continuous winning trades or losing trades. Traders who are consistent in following their trading plan, not looking at trade outcome, are the ones who are consistent in the long term. Traders who allow emotions to drive trading decisions are the ones who lack consistency and are forced to exit trading. Poor risk management. Traders who do not manage risk well are the ones who are forced to exit markets. Traders who give up soon in trading are the ones who risk too much on a trade. A trader should never risk more than the reward they are looking to achieve in any trade. Novice traders don't look at percentage when calculating risk management and capital deployment. Traders who look at points or money aspect of risk fail to realize the kind of damage they are doing in terms of percentage of overall capital. Erosion of capital is high when you are poor on money management and are a high risk taker. Novice traders trade 2 times too big. They are taking 5 to 10% risk on a trade they should be taking 1 to 2% risk on, by Bruce Kovner. High-risk takers, novice traders who don't realize and understand that success lies in consistency are the ones who are forced out of trading. These traders end up becoming high-risk takers because they don't understand low-risk, high-reward benefits. Such traders end up becoming high-risk takers who quit trading sooner than they should. High-risk taking traders are a breed who takes trading decisions driven by emotions. They are so much attached to their trading position that they trust hope more than the market sentiment itself. This hope is crushed by the markets brutally, which results in several traders losing more than half if not the entire capital in a single trade. High-risk takers are driven by emotions, which is the worst enemy of a trader. Traders who have come beyond this stage go on to succeed in trading and trade emotionlessly. Psychological factors. Confidence is good, but overconfidence always sinks the ship. By Oscar Wilde. Overconfidence. We are all aware that markets tend to reward new traders in the initial days or during the honeymoon period of trading. Traders who quit early are the ones who get overexcited about early success and become overconfident. They become so overconfident that they start thinking they cannot go wrong, and they are the ones who are out to conquer the markets. There is a thin line that separates confidence from overconfidence in life and in trading as well. People who understand this line and remain within the boundaries of confidence go on to succeed in life and in trading as well. Discipline is the bridge between goals and accomplishment. By Jim Rohn. Lacks discipline. Traders who lack self-discipline are disciplined by the markets. The magnitude to which they are unschooled is directly proportional to lightning speed in which they are forced out of trading. This lack of discipline is bred by ignorance, greed, and sometimes the thrill they derive out of the addition of trading. Traders who fail to follow the process and have exaggerated expectations become indisciplined. This is a result of poor mindset that they fail to train their mind on. If you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. By Mark Douglas. Weak trader psychology. Traders who don't want to work on their mind to train it to align with market sentiment are the ones who are forced out of trading. Markets tend to reward traders who are aligned with market sentiment. That is why you see that traders who go with the trend in a trending market in the right direction are rewarded. Traders who are adamant and are not aligned to market sentiment are brutally crushed. Traders who go on to succeed in markets are the ones who remain neutral in markets. They are neither biased towards being bullish nor biased towards being bearish. They just go with the flow, and that is all that is required to remain in markets. People who embrace the phrase, last man standing, are the ones who train themselves to remain long enough in the markets to taste success. The process of a novice trader going on to becoming a trader who sees the light at the end of the tunnel is difficult but is doable. I'm sure we have listed out all the reasons why a novice trader is forced to exit trading. I'm sure you can overcome this phase by following proven methods of successful traders mentioned above diligently. A trading philosophy is something that cannot be transferred from one person to another. It's something that you have to acquire yourself through time and effort. By Richard Dryhouse. Chapter 4 Hope Trade. What is hope? Hope is a feeling of expectation and desire for a particular thing to happen. This means that we are sitting on a cushion called hope for our desire to be fulfilled. The characteristic of hope come from looking into the future, are built on faith and comes from God. We all believe in God and faith that comes with it. Well, when it comes to the markets, hope is hopeless. You don't sit on a cushion when you trade and wait for things to happen. You have to take charge and be on your toes, not literally though. You trade on setups, not hope that is an inner desire and not what the market participation may be doing. Leave your inner desires, emotions and hope aside when you step into the trading ring. It's a battle on doing the right thing or not, and hope can have no say in it. Hope, origin. Trading options is a game of probability and a confluence of all minds put together in terms of what the supply and demand are. When trading is a game of probability, it is as good as a yes or no or 1, 1 or 0, 0. It is either you win or lose. There are no two ways to it or anything in between. So, when probability has only two sides of this trading coin, how can hope come in between the two sides? It is normal to consider that a good winning probability of 70% can give amazing results. Well, markets also work on similar probabilities. There may not be a percentage that you can fix though for the markets. It happens only based on the confluence of demand, supply and all factors that can have an impact on the markets. When the game of probability in trading is only two ways, you cannot bring in a third one called hope. You have to be strict with your setup, strict with your stop loss and strict with yourself. Hope and markets. Markets work on similar probabilities to give it to the buyers on some days and sellers on some. Markets work in tandem to give it, winners, to the ones, trader with an incorrect strategy, even if they are wrong on some days. Yes, you are right, but it may not be for 30% of the times, which is a common grace we take for being wrong. Markets tend to hand out winners to those traders who are even wrong on one day. That day market gives away because the overall confluence of demand and supply said it deserved. This gives birth to the hope within you. Market knows if it does not hand out winners to the larger crowd on one day, just one day, then you will probably not come back to trade in the markets. From where will the markets get people who are ready to hand over winners because they cling on to low probability days to the ones who cling on to the ones who work on higher probabilities? So, hope is born on a low probability event and you pick it up. What you should be doing is pick yourself up for the higher probabilities and not the least probable one. Hope is not a strategy and you are not for sale. Let's ensure that we work on setups, strategies and not hope. Hope and emotion. Hope can be the most dangerous emotion for traders because it blinds them to risks and gives a false sense of confidence. Investors acting on hope often add to losing positions, digging themselves deeper into holes they should have climbed out of quickly. Hope is also closely related to pride. We have all had an upbringing that teaches us that you have to do the right thing always and be right all the time. People don't like to admit that they are wrong, leading to let go of a loser trade and do more harm to their own wealth, capital. Risk management becomes impossible when hope starts dictating terms. Terms should be dictated by your trade setup, market conditions and your risk management. We believe in the beautiful evolution called life, which teaches us what goes up has to come down and vice versa. Not necessarily in the markets, price when needs to fall can keep falling and does not have to come up. Not at least now. Hope trade. What is a hope trade? Just like the origin of hope we discussed, hope trade has everything to do with expectations of something that will happen. It is not something that you have a strict rule or setup based on which the trade is taken. If your trade setup says your stop should be given out at 1:2 RR, why should hope step in and change course? Hope is something that works on your subconscious mind to do something that is not even seconded by either price action of data. Did you discuss this with hope when you first initiated the trade? Trade what you see, not you hope to see. Fear of unknown, power of known. We often can associate with the power of known and fear of unknown in real life. Yes, you feel empowered when you are knowledgeable and know what's in store. However, there is always fear surrounding the unknown. It's human nature. Well, in the markets, it's a double-edged sword. Let's see why. This is the very root cause and birth of hope trade as a strategy in you, for you by you. You start to use this strategy every time market has gone against your position or has not been favorable. If you were satisfied with a 20-point gain, why did you have to wait till it went 90 points down? Is this the kind of risk-reward that will give sustained performance? Chapter 5. Trading vs Gambling. Trading is mere gambling, a perception that is framed across the world and more evident in our nation. Trading is a legitimate business that requires common sense to prevail more than any other aspect. We will show what differentiates gambling from trading so you can learn how to trade rather than gamble. Trading is not a jackpot slot machine. What is gambling? Gambling is nothing but writing off money and risking it in a bid to make more money by sheer luck. You are well aware that this money can all be lost as gambling works on pure probabilities. You lose money if the probability is not in your favor, an edge that is always favorable for the house in the long run. There are gamblers like Bill Benter and Edward Thorpe who have gone on to make millions of dollars by mastering the art of probabilities. Trading is not this easier game. Trading is only gambling if you don't have a plan and stick to it. Is trading also gambling? Trading may also sound like it is a form of gambling as it works on the same methodology as gambling, probabilities. However, trading, unlike gambling when learnt in a structured manner, can bring in consistent returns over a period of time. Trading, unlike the general form of gambling, is not like you either win or you lose. If trading is learnt in a structured manner, you can work to mitigate losses and run winners, unlike gambling. Trading requires you to learn about markets, technical indicators, chart analysis, and how to read data and financial statements. All you need to play casino games is to be of legal age and have access to a casino. You don't even need to leave the house today, with the advent of online casinos. Trading is years of hard work, learning, and discipline. This is not the right place if you are looking to make a quick buck. Why did trading get a bad name? Trading is a noble profession which needs a lot of knowledge, practice, patience and a sound mind where common sense prevails. Trading has got the bad name because scores of wannabe quick rich human beings took to trading to become overnight rich. They jumped in it with all the money they would muster with no knowledge whatsoever. When you trade with no knowledge or half-cooked knowledge, you are bound to make losses. When such people do not know when to stop, they earn a bad name for this profession. Yes, you heard it right, we as a society gave trading a bad name because of people who felt trading was like the jackpot slot machine. Trading is purely a game of psychology and discipline, whereas you rely on random probability in gambling. Differences between trading and gambling. Trading can easily be differentiated if you are not treating trading as a business. You will find yourself doing the exact same things one would do when they are gambling. The same behaviors can be seen when one is gambling or is trading with a gambling mindset. Let's see differences between how you trade in a structured manner and when it becomes gambling, something that you may visualize yourself of doing now or have done in the past. In trading, investing, it's not about how much you make but rather how much you don't lose, by Bernard Baruch. Why do traders become gamblers? Winning edge. Traders tend to think like gamblers because of the subconscious mind that is driven by greed and need. Casinos work on the concept of having an edge over the players in the game. This will help to make a killing in the long run. The games in the casino are skewed to win in the long run. Traders do need to have an edge to win, but the mistake happens when you want to win all the time. You want to win big all the time as well. Risk management. Even casinos work on risk management and table limits to contain losses. Traders fail in this aspect miserably and lose big because of poor money management and position sizing. Trading is not about winning every single trade. It's about approaching every trade with a winning formula. How to treat trading like a business? Trader mindset. Have a trader's mindset and use human behavioral biases. Let's say, for instance, if you are a trend follower, you do well when markets collapse because of negative news. You tend to do well because the mind of all traders, investors and the market sentiment in general are all aligned together. Similarly, you should have an edge as a trader that works on different market sentiment, as markets are always dynamic. A trader wins if he has the knowledge to understand market sentiment and make money, be it trend following or mean reversion. Risk management. As a trader, you always carry this in mind that you can go wrong in a trade. You should have a risk management system that does not wipe out your trading account in such instances. You can use several methodologies like position sizing, stop loss and capital deployment to mitigate when your view is wrong. Backtest strategies. Always work on a strategy that is backtested in different market conditions. The backtesting has to be widespread so you can identify winning probabilities of such a strategy in bull runs, bear markets and consolidation phases. Strategies could either be designed by you or by a trader has achieved great results from a strategy already backtested. It is important to test the results yourself if you are using a strategy designed by another trader. The goal of a successful trader is to make the best trades. Money is Secondary, by Alexander Elder. Casino mindset. Casinos always create an edge so as to have a positive expectancy over a period of time. In trading terms, you can consider this as the number of trades taken. Casinos' edge of 5.7%, let's say in a game of roulette, automatically gives them an edge over a player in the long run, number of bets. Similarly, traders should focus on creating an edge in their trading system that makes them profitable over a period of time. The winning probability increases as you grow as a trader. You also tend to minimize loss on trades that went wrong. This increases the profitability of a trader in the long run. How to trade like a casino? It is important to trade like you were the owner of a casino and replicate the casino model in trading. Most of the traders lose because of lack of knowledge, trading plan, so it is important to educate yourself with all necessary tools and resources before you trade. Even if you are on a 50% winning probability plan, you are still good if you have the right risk-reward plan. The problem lies with the emotions that drive your trading decisions when trading. This results in you losing big when you are wrong and winning small when you are right. Emotions always drive wrong decisions in markets due to the human nature that is behind the process. You look up to instant gratification when you are winning and cut winners small. You look up to hope and fear of losing money when you are losing make you hold on to a losing trade expecting a reversal. If you need to apply the same winning edge like a casino would, do you need to have an edge here when you trade? Professional and successful traders always trade on high probability winning trades on repeatable price patterns. These price patterns are formed in the market day in and day out, and you should have a trading plan that can identify this repeatable pattern. Let's say if you are someone who trades supports and resistances, you will look for price patterns that have tested this level at least once before. When you see price heading back to these levels and bounces off from support or resistance, you enter the trade. You enter the trade because there is a high probability of you winning because the price pattern could repeat itself. A professional trader would also cut losses to minimal if the trade went wrong and move on to the next opportunity. There would be no strings or emotions attached to a trade by a professional trader. Yes, a professional trader would study why price behaved in such a manner to refine their strategy if needed. The above example gives you a statistical edge because you are trading on repeatable patterns, which itself increases the probability. Traders with an edge look at winning probabilities in the long run rather than look to win them all and win them now. A professional trader always trades like a casino with a winning probability of 50 to 60% at a bare minimum of 1:2 risk rewards. Do the math and you would not wonder why a trader is successful in the long run if the mindset is just right. Let's look at an example with the above probability and risk management system that will reward you in the long run. Let's consider we risk $0.1000 and take reward at $0.2000 or more. We ensure that we trade only when the probability of win-lose is available to trade. Trading is a profession that requires utmost dedication, passion for trading and zeal to achieve great heights. It is made to sound like gambling when traders display gambling tendencies instead. I'm sure we have cleared the air around trading as a noble profession and how you can trade like a pro to achieve great heights. Risk comes from not knowing what you are doing. Warren Buffett. Chapter 6 Trading on borrowed money. Trading, as you would know, is considered a business, and the only ones who nurture this as a business will grow and succeed in it. Several traders make the grave mistake of thinking of it as a money doubling or a tripling machine. They enter into this business with the false hope to fulfill their previous commitments and quickly. This is a very dangerous approach to trading as a business, and we will see its ill effects and how it in fact ruins your business. We will also see how to actually treat this as a business that can help you achieve your goals in the long run instead. Dangers that can ruin your trading career. Let's look at some of the dangers of working on a fixed income, which is normally unrealistic considering the fact that we will be trading in contrast to the way trading actually works. Probability vs fixed commitments. Trading, as you would know, is a game of probability. You tend to smile when your view is right and frown when it goes wrong. A fixed commitment will force you not to accept a loss on any given day, as you would miss your commitments. This is simply against probabilities, the basis on which markets work. A trader who trades with fixed expectations always looks for the best and highest returns day in and day out. You only end up making the worst returns because you trade under tremendous pressure. The outcome of fixed commitment fulfillment trading. Trading should be done with a calm and composed mind. When you are under tremendous pressure, you invite stress as well. When you invite stress, you end up trading with emotions subconsciously. You don't even know it is happening, and by the time you realize it, it's all over. Trading with the burden of repayment. A trader normally would enter into the business of trading to grow and eventually reap the benefits of it. Benefits like a flexible lifestyle and returns that can beat the broader market returns are some of them. When you are burdened with repayments and fixed commitments of loans, you curtail the power of compounding. The burden of repayments is generally way above the healthy and achievable per day returns. I'm sure you will agree with me on this. Fixed commitments corrupt the mind. When you have fixed commitments in terms of expected returns and repayments, you force yourself to not accept losses in a trade. Mind you, this would happen subconsciously and you simply cannot accept a losing trade. Fixed commitment trading repercussions. Profits and losses are part of the game, and a trader who accepts them graciously to learn from them is ready for success. Here you are not even ready to accept a loss because you have commitments to fulfill. This leads to irreparable mistakes, like overtrading, firefighting with markets, and averaging on hope trades. You know what? You only end up creating a hole in the capital itself. Is there a way out of it? When you trade on borrowed money and fixed commitments, you end up having high expectations. Trading is a business when done with passion and zeal to keep learning and excelling, results in money becoming the byproduct. Money just keeps coming in when your complete focus is on the process and not making money. Process plays a big role in automation. Ask any engineer and he would give you an answer. Similarly, the moment you realize and understand the importance of process, your trading will happen automatically. This will happen automatically and switch to autopilot mode because you would have removed the baggage from the equation. This is the baggage of borrowed money and baggage of fixed returns. Agreed? Money blurs your vision from the process in trading. What do the seasoned traders advise on this? It is best to follow the ways and methods shown by professionals and seasoned traders, as these come from their experience of trading in the markets. Trade in the markets only when you have an emergency fund of 2 years if you want to trade full time. Trade with only the money you can afford to lose. Focus on the process rather than the monetary aspect. Trade your plan, not your emotions. Focus on consistency. Have reasonable targets to achieve. Accept losses, they are part of the game, but keep them small. Treat trading as a business and not a hobby or money-making machine. Food for thought. It is not advisable to trade with borrowed money, as you can see how it affects your trading. If you have already ended up doing that, I would advise that you close your trading account and stop trading further with borrowed money. Should you still choose to trade, consider this: when trading on borrowed money, it is important to have a clear and concise plan of action. This will help you to stay organized and focused on your trading while avoiding potential losses. By following a few simple steps, you can minimize your risks and maximize your potential rewards. Even if you chose to continue this way, understand that traders who have realistic targets in mind survive in the markets. You should always focus on long-term goals rather than using trading as a means to clear loans with a fixed income in mind. It does not work that way. To begin, it is important to check your borrowing limit and the probable gains one can achieve with reasonable and realistic targets. This will help you to understand the potential risks associated with trading on borrowed money. Secondly, it is important to keep track of your trading profits and losses. This will help you to realize where you stand in terms of achieving your trading goals. Do you want to visualize how it would look like when you trade on borrowed money? Read below. Trading with borrowed money and unrealistic fixed income expectations is like getting caught in a whirlwind. The atmosphere around you is that of chaos, and everything that comes its way is blown away. You and your trading career will also be if you continue to trade with borrowed money and have unrealistic fixed commitments from your trading. The dangers of trading on borrowed money and having fixed commitments to repay loans have been discussed above but are rarely talked about. I'm sure you will realize such dangers shared above and follow ways and methods to trade and focus on the process. It is good to shoulder a burden but not good to trade with a burden. Chapter 7: Why you should learn before trading. It is a known fact that a huge number of retail traders lose money in the stock market and 90% of new traders lose 90% of their capital in the first 90 days. Well, that's an insanely high number of traders that one cannot digest. I will simply put it as 90% of traders lose money in their first 90 days because of a lack of knowledge. We will see why learning is so important in the business of trading and what the best approach we can take is. Why is trading education important? Educating aids challenges. Education in short lessons the challenges you will face trading in the markets. We all know trading the markets is no less than stepping into a battlefield. Trading is a battlefield that tests your nerves, your trading acumen, and character. Education builds the foundation. Trading, like any other business, requires sound preparation and a strong foundation that one can create by educating himself. Education develops critical thinking. This is vital in teaching a person how to use logic when making trading decisions. Education is the key to success, and pursuing education is the best option to achieve one's goals in life and his trading career. Education plays a significant role to plan your future as a successful person in life and as a successful trader in future. Education shapes up a clear mind. Clear and straight thoughts come when you know what you have to do and why they need to be done. Education clears the clutter so you can think straight when making your trading decisions. Trading is a game of probabilities and education helps you identify those probabilities. What are the stages of learning in trading? People would recommend that you learn trading from basics, fundamentals to technical and psychology. I will be taking an unconventional approach here and would prioritize psychology even before you learn fundamentals and technical. We will look at the stages that we need to follow in order to learn the game in a proper manner even before we enter into the game. Basics: a broad understanding of what are the markets made up of, its components, and how does price change of different assets. It becomes imperative that you know what are all the factors that move markets and impact price. A composite view of news flow, events, and important levels of price form the core basics that one needs to be aware of and how to apply this knowledge in trading decisions. Psychology: it is very important to start here when you start to educate yourself about the markets and how to trade in them. Psychology plays a major role in your trading aspirations and also determines whether you will be successful in trading or will struggle a little longer. Fundamental and technical knowledge. Fundamental knowledge is very important to know how to study a stock. It helps to read about its past and future prospects that give us a short-term and long-term perspective of the stock. Technical knowledge gives us an edge to understand where we can see price movements headed, what its strength is, and where can price reverse. Formulate a trading plan that suits you. As you start to understand yourself and how you react to the market knowledge gain, you can move on to formulate a plan. It is very important to seek help or guidance from a teacher or mentor in the initial stages of learning. Guidance makes things easier for you and helps you understand finer elements of a trading plan. A mentor will be able to advise if a plan you have formulated will work or not by understanding your behavior patterns and how you react to price movements. Backtest and forward test the trading plan. Most of the new traders fail here and start trading right away. It is very important to backtest a strategy or trading plan to know if its winning probability is good enough for current market dynamics. Backtesting will also help you know if you are ready for this plan based on your mindset. People fail to forward test a plan before they can scale up. Once a trading plan shows a good winning probability on paper, new traders tend to bulldoze their trading with heavy quantities which prove to be disastrous. Forward testing can be done on paper as well to see how the plan fares in live market. Start small and continue the learning process. This brings us to take forward testing to the next step. Start trading in small quantities in your early trading journey as it helps you prepare your mindset. Trading in small quantities will help you understand your character. It helps check if you tend to panic when a trade is going against your plan or if you are overwhelmed when you are right. Both emotions are equally dangerous for trading as they influence your trading decisions. Trading decisions that are taken based on price and data are instead driven by emotions which end up being wrong. Trader mindset and trading. In each of your learning stages, you will need to develop a mindset that matches the wavelength of the markets. You will need to train your mind in each of the stages of learning, right from stock market basics to trading basics right into fundament and technical knowledge. Success in the markets depends on how well or how far you are able to understand the markets. It depends on how you react to market movements which reflect in your trading decisions. Each trading day in the markets adds to your learning about the markets, so this is going to be a continuous process. Continuous learning requires that your mind is open to new learning from pain points and correct decisions taken in trading. Your psychology plays a major role on how you take this information and apply it in your trading. Ultimately, the decision of whether or not to learn before you trade depends on your individual circumstances and goals. However, I'm sure we have clearly laid down the importance of learning before you trade actively. I know you will agree to the fact that learning creates a strong foundation in every aspect of trading after reading the benefits shared above. Education will help you to turn your dreams into a reality. CHAPTERA truth that separates 10% from 90% traders. Intraday trading has been a very rewarding business if you are one of those traders who is disciplined and has realistic goals. We will see what successful traders do day in and day out to achieve this success. Are you ready to move closer towards the 10%? What is the meaning of success? Success is often associated with the monetary aspect only, which is quite natural for novice traders. However, traders who actually succeed in the stock markets understand that there is a lot more than money to it. Traders who realize this at any point of their trading career go on to bring about that change that is required within them. Success in day trading can be achieved only when you bring about that change and create that edge for yourself. Let's look at all the virtues successful traders possess or have worked on to make consistent profits in day trading. Power of knowledge. Knowledge of day trading setups, levels, and indicators is not sufficient to result in success. Awareness of all aspects that can impact price or trend is also critical. You have to also know how to apply this knowledge in a trade, which becomes the differentiator. Trader type identification. Traders who go on to succeed in day trading do this first before they go big on their trading. Traders, which style suits them as a trader and what is the risk appetite? This forms a strong foundation as all other aspects like mindset, money management, and decision-making capabilities start here. Start small. Successful traders always start small to test the waters. They always start small to identify if a strategy will work in the long run. They start small to know if they themselves are suited for the strategy. Trade plans. Always successful traders always trade their plans. When you have a plan, it relieves you from the stress you have to go through when you have none and still want to trade. For example, you know that a gap up is expected in the opening and further movement is expected to be quick. You already have a plan in place which indicates you will not chase a gap up and wait for the price to get rejected at resistance. You wait for this price action and initiate the trade when data at that time also indicates a reversal. Trading with a plan always helps you to avoid FOMO in day trading. When you are free from this fear, you will wait for your trade and take it as per the plan. Have realistic goals. Successful day traders always have realistic goals in mind. They know that day trading is not a money-making machine and you cannot achieve quick success in trading. Success is a journey, and the achievement of smaller and realistic goals help you realize actual success over longer periods. Emotionless trading. Successful traders are in complete control of their trades. They do not allow emotions to dictate terms. Successful traders train themselves to detach themselves from emotions when they trade. Money management, risk management, and position sizing are given utmost importance by successful traders. They always believe in just enough capital to achieve their daily targets. They don't believe in making that quick buck to close trading for the day and relax on the beach. This coincidentally is a fancy imagination that results in mismanagement by novice traders. 1% target rule. Successful traders understand the importance of smaller targets and the power of compounding. When you allow the money to grow, it automatically works effortlessly without having to be stretched. Self-discipline. In order to be successful, you need to be able to stay focused, stay organized, and on top of your work. Self-discipline and self-control are the most important traits that help you reach your goals. Successful traders focus on self-discipline more than any other aspect in trading. Challenges faced by novice traders. Novice traders share some common traits or virtues that hold them back from bringing about that change in them. These traits can be easily identified and eradicated. All that is required is self-introspection and accepting reality. Let's look at some common traits that cannot bring about that change. Unrealistic expectations. Emotional interference. FOMO. Not trade with a plan. Lack of trading discipline. Poor risk and money management skills. Fail to adapt to different market conditions learned through trial and error. Always on the look for the Holy Grail. Simple tips to bring about change. The first thing a trader needs to realize is that day trading is not a means to make quick money. So, realize the fact that success is an ongoing process and always needs to take success step by step. Work on your mindset to identify your risk appetite and capabilities as a trader. When you identify who you are as a trader, you will be in a better position to work on your strengths. Keep learning and keep implementing your knowledge in your trading so you continue with the process of learning and earning. Accept the fact that it is okay to lose on a trade. Successful traders don't look for a % win rate. They focus on keeping the losing trades small and ride the winners. Adapt to changing market dynamics so you can do what is right when change is required. There is no magic wand that can ensure success in trading. I'm sure we have been able to point out some key factors that have been found to be associated with successful day traders. The above mentioned simple tips and characteristics of successful traders will help you identify the trader in you. Chapter 9 How to overcome fear in trading. Fear is one of the most significant emotions in trading that every trader experiences in their early stages of trading. Well, the simplest and easiest way to overcome fear is to trade fearlessly. It's easier said than done. Right, we will simply things for you so you can train your mind to overcome this fear by repeatedly doing the things you are supposed to. This will allow fear to hijack your trading. What is fear? Fear is an unpleasant emotion or thought that you have when you are frightened or worried by something dangerous, painful, or bad that is happening or might happen. Well, if the above is the definition of fear, then the simplest way to overcome this fear is to not think of the outcome. When the outcome is yet to happen and is in no way in your control, why allow it to take over you and dictate terms? Actions that you take based on your knowledge, your confidence of the study and your decision-making capabilities should take care of the outcome, not fear. What are the different types of fear experienced by a trader? Fear of missing out is one of the most common fears experienced by a trader. This fear is caused by the fact that an opportunity is missed out and you somehow convince yourself to not let it go. When you give in to this fear, you are probably entering into the trade when the momentum is about to just die down. This results in you remaining in a losing trade that should have been a winner had you taken the opportunity at the right time. Fear of being wrong is another fear that a trader experiences. Fear of being wrong is culturally inbuilt in our minds where you are expected to be right all the time. Be it education or society, you are expected to be right all the time. When you get into this trading with this mindset, you subconsciously want to win each and every trade. These results in you take wrong decisions on a losing trade by either sitting in the trade too far into the SL or keep averaging. Fear of losses is another major fear a novice trader experiences. Fear of losing money is more detrimental to your trading than making money. This emotion is the result of you not wanting to accept failure as an outcome in trading. Failure can be a result of several external factors that you may not have control over. So this emotion should never creep into your decision-making process and accept small losses as per the plan. Fear of giving back profits is a common fear that is experienced by a trader who has already seen some losses in the past. The kind of losses one takes in the past result in you not wanting to give away profits and want to protect them. You fear to risk from your profits when the trade opportunity is there for the taking because you think you may end up in a loss again. Fear of the unknown is least discussed fear among traders. This fear is experienced by a trader when not aware of how trading works and was probably attracted towards it from some amazing success stories of successful traders. You have no clue if the price will move up or down even by looking at price action and have access to data as well. What are the solutions to the fears in trading? Fear of missing out. Never feel left out. Opportunities are galore in the markets and you may get another one. You should know that today is not the last day the market will be traded in. Fear of being wrong. Building your self-confidence in the trading system you have chosen and back-tested is one way to overcome this fear. Accepting the fact that it is alright to be wrong in trading helps you overcome this fear. Your trading system will take care of the rest in keeping your losses small. Fear of losses. Till the time the thought of recovering your losses from trading is not weeded out from your mind, you will not be able to overcome this loss. You will need to delink the money aspect from your trading to overcome the fear of losses and focus on the system. Fear of giving back profits. Developing a trading plan that have clear rules of entry and exit helps you to overcome the fear of giving back profits. You will focus on the system rather than allow emotions to dictate terms. Fear of the unknown. The best way to overcome the fear of unknown is to improve your knowledge in trading, understanding market behavior and dynamics by reading books on the same help in overcoming the fear of unknown. Pro tips. Risk only the amount you are comfortable losing. Get detached from the money aspect in trading. It's fine to accept small losses, they are healthy for your trading. Upgrade your knowledge in trading. Build self-confidence in your trading system. The best way to overcome all these fears is to keep practicing the solutions discussed above. The more you practice and keep repeating them, they become an integral part of you and your subconscious mind. Take control from here. Chapter 10 How to Trade with Conviction. Conviction is a state of mind every trader should yearn to be in during the actual act of trading. We will see how to train ourselves to be in this state of mind as we proceed. Trading with conviction holds the key to a trader becoming successful. Conviction is worthless unless converted into conduct. Thomas Carroll. How is this state of mind achieved? Conviction is a state of mind that requires a person to have a strong belief. Conviction is a state of mind that comes from making yourself free from doubt. Conviction in trading can be achieved only when you have a strong belief and trust in your trading system. This trust can come only when you have made certain that this system can be profitable over a period of time by backtesting the system. You have to be thoroughly convinced about your trading system before you can actually apply it in trading. So the process of achieving a state of mind that will help you in trading with conviction starts well before the act of trading. Have the courage of your convictions once you have made a decision. Walter Schloss. What are all the aspects that build conviction? I'm sure you would have come across the term, that was a conviction trade, when you interacted with a fellow trader or were seen in trading circles. Conviction trades are normally emphasized on the ones that bring in the biggest of winners to a trader. However, I'm going to even go one step further here. You will be convinced that conviction is a state of mind that allows you to determine which trade should be a winner and which one should be given a pass by the end of this read. Let's look at some of the aspects that help build conviction. Sound trading plan with an edge. Competence breeds confidence, and this can come only when you have a well-defined strategy with an edge. It is important to have an edge, else you will be following a strategy that probably another million traders do. Choose conviction over stubbornness. A trader's mindset is what helps you differentiate between conviction and stubbornness. Trading psychology plays a crucial role here that allows you to realize that even the trade with the highest probability can go wrong. This allows you to take quick trading decisions that help cut out losing trades small and ride the winners long. After all, trading losses should be considered a business expense. Every prudent businessman with a sound mind will want to cut down on expenses. Journaling. Journaling is an important part of trading that I cannot stress less. However, it is one of the most ignored things by novice traders. Strictly maintaining a journal not only helps track your trades but also studies them in depth. When you can filter out trades that have been outstanding winners, poor losers, you can single them out to work on your conviction to trade. When you see a similar data or chart formation in the future that resulted in an outstanding winner, why you will not have the conviction to trade it all out? This also helps you identify a low probability trade and avoid it together or go light. Proper position sizing. I'm sure you are convinced by now that your conviction to trade starts way before the very act of trading. Now let's take this further to the actual crux of conviction. Trading, as you would agree, is for real and your entire account is at stake. If you follow your trading setup, identify the outstanding winners and deploy only that much capital in such a trade that deserves to be deployed. Journaling helps here, so you follow strict position sizing on a low probability trade and run it on a high probability trade. This helps eliminate panic and fear in trading. Self-discipline. This is one virtue that will make or break your trading career if not followed. You as a trader should not accept anything less than 100% of yourself when it comes to trading. Self-discipline, when embraced as a way of life, will only enhance every aspect of it. Trading is no different. Your trading experience and accomplishments will only enhance when you embrace self-discipline with no compromises. Strong convictions precede great actions. James Freeman Clark. What are the benefits of trading with conviction? There are some obvious outcomes that you can expect from trading when you do it with conviction. These will help in sustained growth and profitability in trading. You can go on to create wealth for yourself and your family in the long run when you trade with conviction. Identify trades to go aggressive. Identify trades to hold for long. Identify trades to avoid. Be stubborn on the right position sizing. Be flexible to change. Trading with conviction is the only way you will be able to justify why you trade your plan and derive its full potential. I'm sure reading the above mentioned ways to build trust in your system will help you trade with conviction. Conviction is an emotion that you plant in your subconscious mind and nourish it every day. One day you will act consciously, with a sense of strong belief. Chapter 11. Overtrading is a curable addiction. Overtrading is an act of trading excessively that happens subconsciously and driven by strong emotions. Such a strong emotion is an outcome of significant loss in the past, which we will look at and come up with ways to overcome overtrading. Overtrading. Origins. Overtrading is an act of excessive trading that is usually the outcome of a significant loss in the past that a trader tries to recover. It can also be a result of one fluke trade that came as a jackpot trade that you try to replicate. Jackpot trades are a rare happening, but it entices you to keep taking such trades with the hope of hitting a jackpot repeatedly. It does not happen though. Overtrading due to overcoming a significant loss is rather a more common phenomenon among novice traders. The mind creates a virtual hallucination of quickly recovering the huge loss by taking multiple trades and winning back all losses. Sadly, all trades that are driven by emotions end up being losers. The act of overtrading only increases the mistakes repeatedly, resulting in further losses that only wipe out the account. Overtrading. Consequences. Overtrading is an act we know is driven by emotions that are the last thing we need in trading. Emotions, when allowed to take control over your trading, can result in the following consequences. Further loss, let alone the hope of recovering previous losses, you end up making more. Stress, excessive trading leads to stress, which is again a state of mind that is dangerous for trading. Demoralized self, overtrading that causes further losses only demoralizes you. You start to feel you are not made for trading and can end your trading journey as well. Behavioral change, overtrading makes you more aggressive and take decisions in haste. Decisions that are taken in haste in trade end up being blunders. Self-inflicting, when you overtrade you eventually end up making more losses. This results in you hiding from yourself and your surroundings. You tend to hide the things you are going through, resulting in the truth being hidden. Lack of responsibility, you end up not taking responsibility for your actions and look for reasons outside of you to cover up the losses. Overtrading symptoms. If you are still reading this and feel you are facing the same problem, then you are just in the right place. It is my humble request that you have people that matter to you the most to read this section. These are signs that a trader is facing the problem of overtrading, and it is our duty to identify this and help this person overcome this addiction. Yes, you read it right, it becomes addiction if left unattended and can become disastrous. Let's see the most common symptoms of overtrading that are unintentionally displayed by a trader. Neglecting family or friends unusually than before. Avoid attending to normal activities or a job that a trader would do otherwise before trading. Change in behavior like over-aggression, frustration and suppressing problems being faced. Missed MS or routine bills that would normally be paid off are a new norm. Neglecting physical and mental health and wanting to stay aloof. Avoid phone calls which would normally be taken. Mismanagement of funds is being witnessed. Have a discussion with someone who understands these problems and has overcome it already. It is a behavior that can be changed for good. Overtrade can be overcome? Yes, you can. Yes, you heard it right. As long as you take charge and come to terms with reality and understand trading better, you can overcome this disease of overtrading. Overtrading is poison that should be removed from your system completely. This act, if left to continue in trading, can end your trading journey forever. This was the reason why I said, yes, you can, and not, it can be overcome, because it has to be done by you and will not happen just like that, automatically. Let's look at some proven ways to overcome this disease, overtrading. You have to vow to yourself that you will strictly follow the below suggested methods and you will see a new trader altogether. Take a break. Make it a point to take a break from trading if you have had a 3 stop loss hit or lesser but has reached your maximum loss for the day. Limit your trades. You have to come to terms with it and there is no other way to it. If you have to overcome the habit of overtrading, you have to create a new habit to cling on to. Give yourself a number, it can be 3, 4 or 5 trades per day. Come what may, you have to log out from the trading terminal. Take a break and review your trades, which will give you enough information to learn from them. Seek help. If you feel you are overtrading and are unable to control the urge, seek help. There is no harm in seeking help from a seasoned trader who has overcome this stage. It makes things easier for you by getting into the root cause of the problem and eradicating it completely. No trade. It is a very famous phrase for obvious reasons in the stock markets. Even no trade is a trade which neither results in a loss nor gain. Make it a point to trade only when a trade fits all aspects of your trading plan. I'm sure none of us trade with a plan which indicates a 100 trades being given the nod by you. If that is the case, then make yourself aware that you are not trading with a plan but with a gambler mindset. Reject trades. The best way to avoid overtrading is to learn to reject trades. If you have set 10 parameters to be fulfilled to initiate a trade, ask yourself all the 10 questions. If you get a nod for all the 10 questions, then go ahead with the trade. Tell yourself, there will be no trade if I don't get a nod for all the questions. Can you? Educate yourself. Never let the learning stop. Keep learning and upgrading your skills by reading books and interacting with successful traders. It helps have a clear vision of what needs to be done and how to handle oneself to trade only when it's the right opportunity. Conclusion. Overtrading is just like any other addiction that can be overcome with self-realization and efforts. These are efforts that you need to make in ways that we have shown you above. I wish you all the best in your battle to overcome overtrading. You will succeed as we are with you. This is my 2 cents for you. It's all in the mind that you need to work on. Keep filling it with the information it needs to help you succeed in your goal, and your trading will go into autopilot mode. This activity will bridge the gap between setting goals and working on your goals. The quieter you become, the more you tend to hear. The lesser you trade, the more you tend to become profitable. It's simple human psychology and it works. Stop overtrading. Stop the pain. CHAPTER 12 Position Sizing, the game changer. Position sizing is one of the least looked into aspects by a novice trader. It is though one of the most important aspects in trading that can decide if you go on to be a successful trader or not. We will look at all aspects of position sizing that a trader needs to understand and implement to become a successful trader. Why is position sizing ignored by novice traders? Day trading or trading is often looked at as a money-making machine or is misportrayed as an alternative to investing in the stock markets. Novice traders often are influenced or enticed into making quick bucks by trading, which leads to poor position sizing. A huge position sizing is often used as an easy way to replicate the success of fellow traders and influencers. It is also used as a strategy to recover previous losses. It only adds up to more losses, sadly. Position sizing myths. 1. Heavy position sizing helps you make a quick buck. One of the main reasons for someone to go heavy on position sizing is to think of making a killing when there is a sudden spurt in momentum. If there has to be such a moment, it will sure give you that additional few seconds to add to your position. This is called pyramiding and goes from the lowest position size to the higher one. One thing this assures you is that you are sitting in the right direction. One wrong trade and you make an equal amount of loss if the trade goes wrong. 2. Heavy position sizing helps you recover losses quickly. It is among the most loved aspect of trading of a novice trader that blinds them from the naked truth of markets. A novice trader feels a heavy position taken on the next promising trade will help recover all losses made for the current month. One wrong, opposite move of price in the markets will ensure that you will repeat this myth for the next quarter and for the next two re-adding of funds to the trading account. When you are heavy on quantity, you are blinded to the quality of the trade. This will only fuel further trades with a similar mindset that calls for doomsday to come closer than it would have. Recovery of losses results in your mind working in the same way as that of a loser. Work on every new trade as a new opportunity that has its own length it can reach. The sooner you understand it, the better you will be on sanity in position sizing. Position sizing, the naked truth. Proper position sizing and risk management can determine whether you live another day or not to trade. Position size is more important than an entry or exit. If the position size is too big for an account, even a few points against the direction you traded in will leave you in panic. This mindset will result in you taking decisions in haste and squaring off your position. One of the main reasons for someone to go heavy on position sizing is to think of making a killing when there is a sudden spurt in momentum. If there has to be such a moment, it will sure give you that additional few seconds to add to your position. This is called pyramiding and goes from the lowest position size to the higher one. One thing this assures you is that you are sitting in the right direction. A heavy position size without proper study will result in equal or heavier loss than the exaggerated profit expectation. Position sizing when heavy works like poison as it brings down the account size quickly. You will not even realize that the account size depleting because you will be blinded by recovery or quick money. Proper methods in position sizing. There are several ways to determine position sizing. Here are some of the more prudent ways. Percentage of account size. Fixed per trade position size, volatility based position sizing, standard deviation. Averaging down, highly risky, pyramiding. Risk management. You should be able to accept losses in trades as a natural phenomenon. Your position sizing and risk management should be such that you can take 10 continuous losing trades and be in a position to take the next 20 to 30 trades as well with the same position sizing. The total 10 trade losses should not exceed more than 15% drawdown of your account. No more than 2%, 5% in worst case scenarios should be put at risk in a single trade at any given time. If that trade shows a greater than 5% risk, then that trade deserves to be given a miss. It is as simple as that. You shouldn't have been in that trade at all in the first place. Stop loss. Never adjust the stop loss to arrive at the desired position size, but instead adjust the position size to meet your own risk level. Trade using the same risk parameters in your trades regardless of the distance of the stop loss. Avoid putting more money at risk to put a wider stop loss. Even before you initiate a trade, you should know what position size I should choose. Also know why you arrived at that number, not simply based on the account size. Position sizing an example. Well, there are several ways to work on position sizing as mentioned above. We will look at one way of simply averaging down on proper position sizing. Mind you, the averaging down should not be deployed beyond the stop loss planned. Averaging down is an art and needs a sound understanding of the process and practice before you can actually implement it in your trades. Heavy position sizing is a double-edged sword. While it might look very lucrative if you were rewarded and made huge profits on a big position size in a trade, it is not healthy trading in the long run. There is no one set standard on proper position sizing, as it may vary from trader to trader, as each one's capital size and risk appetite is different. I'm sure you will have more clarity on myths around heavy position sizing, and how to better approach position sizing to suit your trading style and risk appetite. Chapter 13: Trading with Discipline and Consistency. Discipline and consistency are among the two major reasons why a retail trader fails in stock markets. We will see how we can train our minds to achieve these two aspects in our trading to go on to be successful traders. What is discipline? Discipline in the literal sense is the control you gain over your mind to obey certain rules. These are rules that require you to follow a certain pattern or behavior in order to achieve the desired outcome. We often relate to the terms of training and punishment when you disobey the rules. Discipline is a state of mind that requires you to perform the same action day in and day out because we know the ultimate goal we need to achieve. Discipline in trading also requires you to act on a set of rules you have created for yourself in order to achieve the ultimate goal. What is consistency? Consistency in trading in the literal sense means that you perform the same actions with discipline regardless of the outcome. Consistency requires a long-term commitment from you and involves sustained effort in doing actions repeatedly until you achieve your goals. We will look at an example of what consistency means. In trading, let's say you created a set of rules that require you to take profits when you are 20% away from your buy price and book a loss when you are at 10% below your buy price. Performing this action regardless of the outcome is what makes the act consistent. You do not deviate from the fact that you are to book a loss at 10% lower than the buy price. You do not convince yourself to move further down to 20% below the buy price to book a loss. Discipline and consistency in trading. Discipline and consistency are the two keys to the health and fitness of your trading. Consistency and discipline go hand in hand, as these two characteristics support each other very well. These two characteristics, when trained and repeated, go on to become habits. We all know habits die hard. When discipline and consistency become habits that you start to love, your trading becomes effortless. When your trading becomes effortless and becomes a habit, it is hard to beat you as a trader. Simple ways to be disciplined and consistent. As we all know by now, discipline and consistency go hand in hand. I'm going to share some simple ways that we can make this into a habit. When we start embracing discipline and consistency as a habit, the sky becomes the limit. Always set smart goals. Always trade your plan rather than emotions. Become a reactive trader rather than an impulsive trader. Embrace good trading habits like avoiding big risks, maintaining a journal, and constantly learning. Trade regularly when you get a go-ahead on your trading setup. Take a break after a big loss, retrospect why you broke the rule. Be a stubborn money manager. Realize that success comes when you win over yourself, not the markets. Self-review and improvement. Motivate yourself. Don't focus too much on individual trade achievement, as it's part of the larger goal. Never let go attitude. Trading with discipline and consistency. An illustration. We will make things easier for you by displaying how being consistent and disciplined can be a game changer for your trading goals and career. In the image below, we have considered that you trade with a capital of 1 lakh rupees for ease of understanding. Your per trade capital deployment is 10% of your trading capital. Your risk to reward ratio is 1% and 2% respectively of your trading capital. Trading with a lack of discipline and consistency. The section towards the left of the image is of a trader who is indisciplined and inconsistent with his trading rules. Rows highlighted in red indicate that the rules were broken on these trades. We can also see that in some trades rules were broken big. When you become indisciplined and inconsistent in your behavior, you are bound to make big mistakes. These happen subconsciously and you often realize when the damage has already been done. Even with an indisciplined and inconsistent behavior of 7 trades, look at the dent one can create in his profits. When this becomes a habit, then the next stage in your trading without a doubt is a dent in the trading capital itself. The section towards the right of the image is of a trader who is disciplined and consistent in his trades. When you train yourself to repeat these actions day in and day out, you can go on to create wonders in your trading career. The benefits of making discipline and consistency a habit can be overwhelming and prove to be a game changer in your trading career. I'm sure you will embrace discipline and consistency by realizing their importance as shown above. Chapter 14: Time Management. Time waits for no one. Effective time management helps prioritize tasks and you don't have to rush to only end up having adverse results. We will see why time management is important for a trader and how to organize time to maximize results. The quality of work increases many-fold when you are not rushing to get things done. Why is time management being important? Time management is an important aspect in all industries, education, medicine, and the financial markets as well. As day traders, especially managing time not only helps avoid unnecessary stress but also become profitable. Time management can often improve focus and overall efficiency as well as avoid procrastination. We will see what are the benefits of time management and how we can organize time better to achieve better results. If I had 6 hours to chop a tree, I would spend the first 4 hours sharpening the axe, by Abraham Lincoln. Benefits of time management. There are several benefits of proper time management that can help you in your trading as well. Time management, when picked up early in your trading career, can help you immensely in being disciplined and focused. Here are some of the benefits of time management. Reduce stress. When time is not managed properly, it leads to anxiety and stress. Both these are equally bad for your trading as it leads to bad decision making. Proper time management helps reduce stress. Prevents procrastination. Procrastination is the act of delaying tasks to the last minute or past the time as well. The very act of delaying things itself has negative consequences. Doing things on time or beforehand allow you to remain calm. Calmness is an emotion that every trader will benefit from. Boosts confidence. When you have things in place and on time, it helps boosts confidence. Confidence is a state of mind that allows you to be calm and composed while trading. Self-discipline. Better time management results in you working on your self-discipline as well, which can have a ripple effect on other aspects too. Prioritize work. Better time management help in prioritizing work so you can get things done on priority. Things or tasks that can distract you can be avoided or rescheduled for another time. Your greatest asset is your earning ability. Your greatest resource is your time. By Brain Tracy. How does time management help in trading? Trading is a business that requires a trader to remain focused and disciplined. Better time management helps you to focus on your trades rather than look to complete a task that can distract you from your trading. This can provide to have negative impact on trading, with be it emotionally or monetarily. Time, when managed wisely, will give you peace of mind, which in turn keeps you open to identify the right opportunities to trade. Time management helps you maintain a routine around things that are prioritized, and these become a habit when done repeatedly over a period of time. Let's look at some simple and effective ways to manage time in a way that can help you with your trading. Good sleep. Cultivate the same routine to get a good 8-hour sleep. A sound sleep helps you stay refreshed through the day and avoid burnouts. As trading can be stressful at times, a sound sleep can help avoid these burnouts. Prioritize tasks. It is important to prioritize tasks well beforehand or your trading hours so you don't have to panic when you trade. Trading requires that you remain focused, and any sort of activity that can cause panic can have negative consequences as well. Allot sufficient time to read, analyze markets, charts, global and local news, and for your family. Trading checklist. Always maintain a to-do list for your trading as well. Maintaining a to-do list helps ensure that you have done all activities that keeps you ready for trading. Your checklist could include activities like Global Market Watch, Asian Market Watch, and other factors if any, post-market analysis, pre-market analysis. There could be others that you might already be doing that are part of your trading preparations. Time off. Always have a routine time off schedule for yourself during and after market hours. You can plan activities after market hours that allow you to relax. This is very crucial to help you recover from any burnout or stress you may have come across during your trading hours. Many traders fail to schedule time off during their trading hours and remain glued to their trading terminals. Traders tend to be reckless towards eating and relaxing habits during trading hours, which only increases stress. Always schedule or pick a time to take breaks from trading on an hourly or 2-hour basis, as stress can take a toll on your mind. Pick specific hour intervals. Move around to avoid getting glued to systems that can hurt your back and eyes. Trading at times can continue for long hours, and lack of movement can prove to be harmful to the body and mind. Avoid disruptions. Schedule activities in a manner that you avoid any disruptions during your trading hours. Any activity that can distract you from trading can result in poor decision making that can hamper trading gains. If you want to be more productive, you need to become master of your minutes, by Crystal Payne. Simple time management hacks. Chapter 15. Truth about trading capital and profits. Trading capital and profits are important to the success of a business. Just like any other business, they are equally important, both you and your business. Trading, as we all know, has not got it due as a business because of the magnitude of trading community that fails to succeed in this business. We are going to look at 3 simple yet powerful things that successful traders do. 3 simple tips to help you manage your trading business. Apart from a trader's mindset, these are equally critical aspects that decide whether you will be a successful trader or not. These are as usual overlooked by novice traders because they feel they are too difficult to manage. We will talk all the truth behind it and simple ways to effectively manage our trading account. Capital management. Risk management. Profit and loss management. Capital management. Well, capital management might sound some strong terms too difficult to handle. Well, I will keep it as simple as possible for you to understand the core concept and how best to optimize your capital. Capital management is nothing but a system or set of rules you decide based on your capital size to deploy in a single trade and over a period of time. Simple capital management is what allows you to protect your capital and better optimize this resource for long term. Your capital is the core working tool in trading, so protecting the capital is your prime responsibility. Simple ways of splitting your capital into parts makes it easy to manage capital over longer periods in trading. Not using more than 10% of your capital in a single trade allows you to take another 50 trades, with straight losses. Yes, you got it right, you can do it with proper risk management. Capital management. Well, capital management might sound some strong terms too difficult to handle. Well, I will keep it as simple as possible for you to understand the core concept and how best to optimize your capital. Capital management is nothing but a system or set of rules you decide based on your capital size to deploy in a single trade and over a period of time. Simple capital management is what allows you to protect your capital and better optimize this resource for long term. Your capital is the core working tool in trading, so protecting the capital is your prime responsibility. Simple ways of splitting your capital into parts makes it easy to manage capital over longer periods in trading. Not using more than 10% of your capital in a single trade allows you to take another 50 trades, with straight losses. Yes, you got it right, you can do it with proper risk management. Risk management, it is important. Risk management is the most essential but often overlooked aspect in trading by novice traders. It is the most important aspect in trading that can help you overcome emotions that hamper with your decision-making capability. Proper risk management helps cut down losses and opens up newer opportunities as and when they occur. There are several simple and effective ways to manage risk. Pulse has a perfect tool, the risk calculator, that allows you to manage your risk per trade and as per the capital deployed. Below are some simple yet effective ways to manage risk. Follow the 1% rule. Plan trades. Plan exit and entry points. Demark demand and supply zones to give you an overview of the best possible R/R ratio. Risk management is the most essential but often overlooked aspect in trading by novice traders. It is the most important aspect in trading that can help you overcome emotions that hamper with your decision-making capability. Proper risk management helps cut down losses and opens up newer opportunities as and when they occur. There are several simple and effective ways to manage risk. Pulse has a perfect tool, the risk calculator, that allows you to manage your risk per trade and as per the capital deployed. Below are some simple yet effective ways to manage risk. Follow the 1% rule. Plan trades. Plan exit and entry points. Demark demand and supply zones to give you an overview of the best possible R/R ratio. Why is it so difficult to manage profit and loss in trading? Managing both profit and loss is a difficult aspect for novice traders. New traders simply focus on profit or loss that appears in the trading terminal. The anxiety of a loss and being overwhelmed with a high profiting trade often lead to poor trade management. Both profit and loss should be determined by the plan with which the trade was executed, rather than the P&L that shows up on the trading terminal. Trading looking at P&L that is displayed on screen manifests emotions that one should avoid while trading. Urge to get out for a break even. Recover the previous loss quickly. Pray for more winners. Cut winners to avoid giving away unrealized profits. Simple yet effective hacks to manage better profit and loss. Plan trades. Stick to risk management and stop loss rule. Stick to position sizing rules. Use different tools for charting and trading. Hide the P&L screen once take profit and exit are entered. Focus on the process. Build your self-confidence. Myth on trading capital and profits. A lot of people believe that trading capital and profits are two separate things. However, this is not always the case. In fact, it is often the case that trading capital and profits are one and the same. This is because when you trade capital, you are trading money that you have already invested. This is the same thing that happens when you trade profits. You are trading money that you have already earned or generated. Trading away your profits and allowing losses to run can create a dent in your capital. Pro tips, mantra of successful traders. Always trail your stop loss when price is above break-even price. A disciplined trader will never let emotions to interfere with his or her trading decisions. Even if you have the right mindset, you need to keep learning so you upgrade your knowledge in trading. Do not be rigid with rules and trading systems. You need to adapt to changes when market dynamics change. Create a system for yourself that eventually results you to take fewer trades as you progress in your trading journey. All of this is possible when you follow above mentioned simple techniques followed by successful traders. Preserving capital and effectively working on profit and loss can easily be achieved by following simple yet effective ways followed by successful traders. You can also evolve as a better and successful trader by simply following the tips provided above. Chapter 16: How to stay in a trade for the time it deserves. A lot of traders find it difficult to stay longer in winning trades and exit from the ones that don't deserve to be in the trade any longer. We are going to see reasons why traders fail to ride winners instead ride losing trades. We will look at a structured way of staying in the trade for the time it deserves. Why do traders fail to stay in a trade for the time it deserves? Lack of knowledge, understanding of market movements, and no access to data are one of the most common reasons traders fail to ride winners, and instead ride losers. Traders allow emotions to take over the decision-making aspect of trading, which results in traders exiting early or not exiting at the right time. What is a market movement made up of? Market moves are based on collective speculation of all traders and demand and supply. The market always does not make a vertical move in either direction and takes pauses at all instances. Traders either decide to exit out of winners or lose trades. When does one stay longer on a winning trade and cut the losing one short? These are all some aspects that a trader might have seen in educational videos and training programs. They still fail to execute them while trading due to lack of practice and allowing emotions to take over. A fair bit of understanding of how prices move and what kind of data should be looked at is required. Traders don't have a proper trading plan that can clearly indicate where to enter and where to exit in a trade. Traders fail to follow the methodology of either taking a stop loss of book profits only at target price, well with a trailing stop loss though. Lack of knowledge and self-control result in taking poor trading decisions, and traders fail to be in a trade for the time it deserves. How to identify when to stay in a trade? As it has been observed, you will only 20 to 30% of the days where markets are trending in one direction. These are the appropriate days to stay in a trade with a trailing stop loss. All others days should be cut out at the stop loss come what may after that. All other days could be given to sellers and trending days rode to the full. Ways to stay in a trade for the time it deserves. There are several ways to stay in a trade that deserves one. We will see some simple yet effective ways to accomplish this. When you have data like the one below of the 28th of July, 22 which clearly indicates that buying is emerging at all the dips in price, you can simply ride the trend for the day as it deserves it. This is how you stay in your winning trade because data is there to support it. Trailing stop loss using higher high, HH, and higher low, HL, movement indicates a trending day that deserves to be taken to the hill. As the price moves higher, you can move your stop loss higher and keep the trailing stop loss at the previous low candle. You can use the super trend to move stop loss to the super trend levels once the price moves higher from the previous lows. Data is also indicating that buying is emerging at every dip. As you can see, put writing keeps on increasing throughout the day. Cut loss when a trade does not deserve a hold. There can be instances where you see a bearish sign with the price falling considerably from the high in the first 5 minutes. There is a gap that could be filled and you have entered into a bearish trade at the third candle open with stop loss at the previous candle high. The trade goes wrong and the price does not move further down to close the gap. Price moves further up and hits the stop loss level. There are no two ways here and you have to take the stop loss and cut losses sooner or at pre-updated levels. When data indicates that there has been significant buying happening and a huge difference in put writing than call writing, why should you still remain in the bearish trade? Retail traders normally tend to sit on hope trades waiting for the price to come back to break even or hand over a profit because there is a gap that is yet to be filled. Retail traders tend to average down on a losing trade as well, which can be even more disastrous than staying in a losing trade. Capitals are wiped out in this way when you should have taken the small stop loss as per the predefined rule of the previous candle high. Riding winners long and cutting losses short is in your hands and the way you trade. It is as simple as setting a rule for you and following the rule. I'm sure simple yet proven ways shared above will help you form a rule that you can follow to stay in a trade if it deserves it. Chapter 17: How to stay focused and take smart decisions all day long. Achieving success in trading is possible only when you make the right trading decisions at the right time. Taking the right trading decisions at the right time and executing the trade come from remaining focused. Let's see why it is important to remain focused not only during the trade but also before and after the trade. You don't get results by focusing on results. You get results by focusing on actions that produce results, by Mike Hawkins. Importance of staying focused. Staying focused comes naturally to some people, but this virtue can be worked upon if one can realize the importance of staying focused. Remaining focused helps to devote time and effort to the task at hand and improve the quality of work. Greater quality of work ensures the outcome is better and free from errors. Remaining focused helps to avoid errors, which is wiser to do than rectifying them. Your ability to remain focused for the period of time required is instrumental to your success in trading. Effective ways to remain focused in trading. Don't worry if remaining focused does not come naturally to you. It is a virtue that can be worked upon by following some simple and effective ways to remain focused. Stay healthy and fit. Focus can be maintained only when the mind and body support each other. Focus comes from a calm mind, which is possible only when you take good care of your health. You need to ensure that you are rested and relaxed so it does not provide any hindrance to the mind to do its job. Avoid stress. You have to be conscious of your stress levels so you can be in complete control of it. Taking control of stress can help avoid the depletion of psychological energy that is wasted during high stress levels. Avoid distractions. Distractions can come in many forms, and all of these results in poor trading decisions. Avoid unnecessary phone calls, and stay off social media that can divert you from your trading plan and decisions. Any diversion only ends up making wrong trading decisions that can prove to be costly. Mirror talking. Talking to yourself can be of help if you are someone who gets distracted easily. Talking to yourself and asking questions can help you remain focused. This can be of great help as trading is a business that you do by yourself and all alone. You can ask questions or talk to yourself like, is the position size correct? Let me wait till the support level. Am I following the trading plan? Meditation. This is probably the best way to help you remain focused while you trade. Meditation helps you remain calm and composed and adhere to your trading rules. When markets can get volatile and make erratic moves, it is important to fight the urge to jump onto trades and remain calm and patient. Keep trading simple. Many traders complicate trading with too many indicators and an overflooded watch list. Depending on too many indicators only creates confusion, as each of these indicators gives different indications in different time frames. An overflooded watch list only distracts you from remaining focused on one stock or strike price. Shuffling between too many scripts or strike prices only delays decision making, which can result in wrong trading decisions. How does remaining focused help with the right trading decisions? Day trading is often misunderstood as a business that requires you to trade every candle that is being formed. Day trading, even though is played through 6.5 hours in the day, does not require that you trade all the time. Remaining focused help you to limit your trades to the bare minimum and convert only those opportunities into a trade that fit the bill. A trader who remains focused will wait for the right opportunity to trade. All that is required to achieve the day's target is 1 or 2 good trades. These trades can be taken only when you make the right trading decisions to trade only on those 2 opportunities. You only have to do a few things right in your life so long as you don't do too many things wrong. By Warren Buffett. Secret on remaining focused that no one talks about. Traders often misinterpret day trading as an activity that is done through the day with numerous trades. Remaining focused helps you to avoid all those moments that look like a trading opportunity. Trading right is all about waiting for the right opportunity that gets full confirmation from your trading setup. Taking the right decisions to trade is enough to pick 1 or 2 opportunities for the day to achieve your day targets. Remaining focused all the time to avoid the trades that don't fit your trading plan is more important. It is also an aspect of right decision making to avoid the trades which justify the right decisions when you actually trade. Making the right decisions to trade could just be 10% of your day in an actual trade, for the day. Taking the other 90% of trading decisions to not trade are equally important and can come only when you remain focused all the time. All it takes is 1 or 2 trades in a day to achieve your trading goal for the day. This can come only when you remain focused 90% of the time, if not 100%, to be right on the 10% of times you trade. I'm sure you will be able to understand the importance of remaining focused and how it helps in your trading from the above mentioned ways. Focus is a matter of deciding what things you're not going to do. By John Carmack. Hope you enjoyed reading the book. To get into the skin of things, you can join our mentorship program. This is a unique program that is conducted in live markets by Mr. Sivakumar Jayachandran, performing live trades to deliver practical knowledge.